Okay, let's talk about probably one of the most important skills that you can get as a manager, and that is how do you read financial statements? How do you use them to analyze data? So let's talk about analysis first. What does that mean? We can very easily calculate some numbers, put them on a slide, and show what the numbers are. But that's not analysis. That is description, if you will. Analysis is all about what do those numbers mean? What do they tell you about the company's current financial position, their financial position that's changed over time? Sometimes we might be able to make analysis about our relative performance compared to industries or competitors. But in the end, analysis is more than just a description of the numbers. In the end, it could actually even include recommendations for improvement. So when we think about analyzing, right, let's get away from thinking about there's a set of numbers. Let's think about what do the numbers tell us. So we're ultimately working our way to try to talk about intrinsic value. So what does that mean? Intrinsic value is the underlying value of the company, not its stock price, but its value as seen by management, its value as seen by investors. But we're ultimately looking now at this analysis phase to help us understand, maybe predict some values. So overall, what we want to do is compare. We want to look at our company. We want to look at our company versus other companies, maybe to the industry. Everybody uses ratios. Having the ability to discuss them and understand their importance to the company is, again, as I mentioned earlier, is a skill that companies are looking for. They're looking for somebody that can help them improve performance. So let's talk about profitability ratios. I don't think we really need to define them, right? But from an analytical point of view, this really is talking about control. How well does management control the things that it can control? So we want to look at some income statement items, and then we also want to look at some balance sheet items that all measure profitability. So the income statement items, we're going to look at profit margin, operating profit margin. Sorry, this should be gross profit margin, operating profit margin, and the net profit margin. From the balance sheet, we're going to look at something called the basic earning power and the return on assets. Now, those two ratios are very similar to each other, but one gives a much different view of the world than the other. And then we also have return on equity. So let's move forward. Let's think about the first set of profitability. So here we look at CORS, the gross profit margin. Gross profit tells me how I control the expenses of producing my products. And again, if you just look at the numbers, you see they don't really change that much. And up on top here in this blue line, we see that as far as controlling the expenses of producing beer, they're very stable. It doesn't change much at all. So their production is very stable. But now let's look at the other line items. Operating profit margin. What does that incorporate? All of the production things, which we know are very stable, but now we also look at marketing, salaries, research and development, all of those other expenses. What we find is that there has been some declining control. I mean, not terrible amount of decline, But it does seem like there's been some years here where we've had to be concerned a little bit about the control of our expenses outside of production, but also outside of financing. So this is really that middle piece of operations, which is all about, as I mentioned, marketing, salaries for our upper level management, our research and development, those other expenses. If you look at the net profit margin, then it's going to follow that number very, very closely. So we see that there's been some decline in there. So if I were a manager, my concern for the company is all right now would be all about looking at operations. What's going on there that we have this big dip? And we know 2020 was a weird year, but this started actually in 2018. So we want to take a look at what has happened over time to see if we can understand what's going on. Again, as I've mentioned several times, we see that in 2021, it appears to have almost bounced back. But this drop is something that I would have been concerned about. So next, profitability ratios with respect to the balance sheet. So let's talk about return on equity first, because everybody kind of understands this is the rate of return that is earned on the equity investments of the company. And if you look at the blue line here, you can see that again, there's been some huge downturns over the last couple years. So for some reason, Coors has been providing less returns to the investment dollar from its equity shareholders. Again, something that I'm sure the shareholders are concerned about. Again, let's not think about 2020. Think about the other years. You can see that, from 10.5, even with the upturn here in the last couple of years, we're at 7. We're still, 30% less than we were just 5 years ago. So we really should take a look at what's happening inside the company. Either we have too much equity, I don't understand how that would happen, or we have to be concerned about the profitability of the company. And we've seen that there is some decline in profitability over these middle years. Now, return on assets and the basic earning power are very similar numbers. The difference between the two is financing. Return on assets is net income divided by total assets. So it looks at the bottom line of the company, which includes all of operations, all of financing, and all of taxes. So it includes all of those things. Basic earning power is EBIT divided by total assets. So it looks at just the operating profit of the company. So from a performance perspective, basic earning power is a much better number to look at, especially if we're making comparisons to other companies. And of course, what we can see here is that with the exception of a couple years, it is pretty stable. Again, there has been this big downturn, 2000, but in general, 19 and 2000, there were some issues there. Not sure what that was, but we would want to investigate that. The return on assets, we'll see, it's going to be very similar to basic earning power, but it incorporates financing. So what would happen here is, what if I wanted to compare this company, and I don't know that this is exactly true, I want to compare Coors to Budweiser. But Budweiser has, I'm just going to make up the number, Budweiser has half of the solvency than Coors. So Coors has much more debt, which means they have more interest, which means taxes are probably going to be a little bit less. But their profitability is going to be low because they have more interest expense than Budweiser. That is going to have an influence on ROA which makes it difficult to make comparisons. So, return on asset, again, if it's lowered by debt, I've already talked about this. So interest expense lowers that, so it's going to have an impact on ROA. The use of debt, though, also lowers equity. So if equity is lowered more, then you would expect ROE would increase. So this kind of reflects a strange concept, if you will, that basically says if you borrow money, you're going to increase the rate of return to owners. So let's see if that makes some sense. If a company cannot borrow, that means they cannot buy more stuff, right? They can't increase and expand the company, which means their profits are going to be at a certain level and won't be able to increase. But if they can borrow, they can increase operations, increase the cash flows and the income that comes from more production. But because they're borrowing, if they borrow to buy those assets, they only have to pay the interest. And of course, they have to pay back the loan, but they only have to pay the interest on that loan. All the other benefits all go to the owners. So when you can borrow, because of the smaller costs of borrowing, greater benefits accrue to the owners of the company. So there's a saying here that says, it's always better to use other people's money than to use your own money when you're trying to expand the business. I think most of us probably have heard that. The next set of ratios is all about asset management. How efficiently do we use the assets? We've purchased assets to run the company. Now let's see if that was a good idea or not, or are they performing the way we need to? So we can divide this into short-term and long-term assets. DCI is days carry inventory. This is on average, how many days does inventory sit on the shelf? DSO, days sales outstanding. On average, how long does it take people to pay us the money they owe us when they purchase from us? And DPO, days payables outstanding, how long does it take for us to pay our creditors? The long-term thing looks at our efficient. Are we using our assets efficiently? Looking at fixed assets, obviously the long-term question, do we have the right fixed asset base for the level of sales that we have? Again, total assets just looks at the entire question of, do we have an asset base that provides the opportunity to get great profits for our company and our shareholders? So DSO and DCI, right? These are days sales outstanding and days carry inventory. Again, if the blue line is days outstanding, you see that it is fairly consistent, pretty much in the 30-day range. I think most people would say getting your money paid back to you in 30 days is a pretty good deal. So it works out well for us. Days carry inventory, we can see that that number is now growing, right? So for some reason, our inventory is slowing down. Why could that be? Again, if you look at 17, 18, 19, it's fairly close. In 20, guess what happened? Well, we're probably going to have more inventory because we sold less during that time frame. And I'm assuming it's probably going to continue on for a year or so till I can get those inventory numbers back down to a more palatable level, if you will. So accounts receivable is not a problem, but we do need to address days sales outstanding. Now, days payables outstanding is separate here because I have not found many financial statements using this formula that it really makes sense, right? I mean, this essentially is telling us on average, it takes about 100 days for Coors to pay their creditors. Now, we know that is probably not true, right? So the formula that's used here uses sales. Probably should more likely be cost of goods sold rather than sales, because that gives us a more closer correlation between the inventory being used and being paid for and paying for that inventory. So again, the way the textbook uses that formula, it creates a kind of a weird number. But on the other hand, we know that it's fairly stable, right? 80 to 100, I mean, it's a 30-day range there. It has increased pretty dramatically in the last couple of years. Again, I think we know why that's happening. The conversion cycle is a combination of those ideas, right? So it looks at, on average, how long does it take us to get paid for things and how long does it take for us to pay for them. So it is a combination, days sales outstanding, days carry inventory, and the accounts payable ratio. And we can see here that the number is negative. So we would like this number to be as close to 0 as possible. Negative is not bad, right? Very negative is very bad. And again, I think the reason for this is the very large numbers that we find in our days payable calculation. So what does this tell us in general? It tells us that there has been a decline in our cash, right? We need to figure out how can we get this cash a little bit quicker, right? So we need to figure out what to do with accounts receivable. We're doing fairly well with that. Maybe we could get a couple days quicker. We need to reduce the number of days of inventory. But we do need to look at our payables and make sure that we're paying them at a reasonable time. The last set of ratios here is long-term efficiency. If you notice, these numbers are pretty flat. So the fixed asset turnover ratio is around the 2.5 range. Shows us essentially that over the last 5 years, we have used our plant and equipment very consistently. Would we like to get some more efficiency? Probably we would. We should maybe try to compare this to an industry or compare this to a competitor to see how we stack up with them. But in addition, if you look at the total assets, it's stable. It's not changing dramatically. So long-term efficiency, we are looking very stable. On the short-term efficiency, we really want to explore a little bit further that days payable number because it really doesn't make sense to us. So that's it for this video. I'll talk to you next time. Bye-bye.